We have Krishna Sangvi joining us today from Manulife, Mahindra Manulife AMC, and he's been very lucky because Krishna just 4 months back launched a mid-cap, small-cap fund. So it was very well timed, I would say, very well thought of, Krishna. Congratulations on that. I'm sure you would have benefited a whole lot because you started deploying at the right time. Before we talk about mid-cap, small-caps, I just want to understand what are the hypotheses of the market right now after this sharp rally?
I think clearly there are two ways to look at markets. One is earning, other is valuations. So let's look at earnings. India is growing, Indian corporates are growing, and so to an extent, earnings are on the uptick. What changes in the economy perhaps is the business mix of which companies make more profits or which set of companies makes more profits. So FY23, if you look at it, maybe clearly the lion's share of profits has gone to banks. Partly it would have come at the cost of metals and partly at the cost of all other sectors. So let's not forget, FY23 was a real big year in terms of how tightened substantially 250 basis points rate hike in a single year. So a lot of loans got repriced. So to an extent, banks got more money for the same old loans which they had issued maybe years back or so. So in a way, the profit pool participation in Indian economy went to banks in FY23. That's one thing. But earnings net, we've grown as a country. As Nifty's earnings are up. A lot of companies, small, mid, etc. Profits are up. Let's look at the other dimension called valuation, and that's where you always enjoy to invest in markets when, despite a decent earning growth, markets are offering in a way a similar value as what it was 12-18 months ago, and that's where we are right now. We've gone through a 18 month of broadly a flattish market. Yeah, it had its own volatilities, but a flat market over 18 months with earnings growing. So that's where valuation gives you a comfort. Yes, we are in the spot where it's ideal time to buy some of those companies where they have not participated in the market. Even market has not moved much, but I'm sure earnings have grown at many places.
So, of course, valuation is something, but markets. I want to understand from you one behavioral pattern in the market, because on the recent data point shared by SEBI showed that the market activity is getting heavily tilted towards traders. How are you analyzing the success rate for traders, the way activity is getting tilted toward traders? If you look at the result presentations of some of the large brokers, they themselves are saying that cash market, long-term based activity is going low. What is this kind of a change which we are seeing in the market? Is it healthy?
Yeah, so let's look at the raw data. Raw data says that in CY 17, which was 6 years ago, broadly cash market participation was 5.4% vis-a-vis the total market participation. Basically, cash as a percentage of derivative market was 5.4%. In CY22, the data says the participation percentage has dropped all the way to 0.5. So other way around, for every 1 rupee of traded market value, there were 19 rupees of derivatives 6 years back in terms of notional value. Today the ratio is every 1 rupee of cash market is 199 rupees kind of thing for derivative market. So clearly the market has moved to a traders market. The biggest problem for this traders market really is the definition of long-term, short-term changes materially from an investor. So when we look at companies, when we evaluate companies, our own customers, mutual fund unit holders, for them, long-term really is maybe 3 years, 5 years, 7 years, depending on what it matters to them. And short-term perhaps is 1 year. If you look from a typical trader profile in a derivative market, unfortunately, the time frame for them is perhaps as low as one single expiry, which is their ability to hold to that position. So when markets are dominated too much by this trading behavior in terms of the quantum, many times the right set of companies, they are not able to participate because the positions in the derivatives are really driving the behavior. And as we know, all derivatives are by definition leveraged. That's where your angle of SEBI data point comes in. Yes, clearly, data was clear that 91% of people end up losing money when they enter through a leverage route of derivatives. But unfortunately, Ajay, as human mind says, everybody believes they would like to be part of that 9% and not the 91. So people still try and experiment. But unfortunately, the rules of the game of leverage are clearly against them, where they end up typically losing far more times than winning.
Input, I must say, Krishna. How are you looking at the upcoming Fed meet, 2nd and 3rd of May, the first week of May, in light of how Q1 GDP slowed down today by a very wide margin, in light of how the PCE, the most watched Fed indicator, actually slowed down? It's decelerating, and other economic data also is weakening. Do you think it will be enough to hold the hand of the Fed? And also, in light of that, how do you see RBI? Or do you think the two are delinked now?
Yeah, sure. I think as far as the monetary policies are concerned, there is clearly a linkage between what every other central bank in the world, being the underlying currency, which is the most dominating in the world, that drives. Now, if you come to what RBI policy does, RBI policy is far more effective on managing the Indian economy. It manages Indian corporates, profitability, etc. And I'll give you an example. Current year, as I was saying earlier, FY23 had a very large amount of interest rate hike for many of the old loans. So for many customers of banks, their ability to pay interest would have been impacted, but they were forced to pay interest because nobody wants to default. So to an extent, your money power spent on other activities, which is discretionary, goes down. Big number, 135 lakh crore kind of loan book, which Indian banks have, assuming a 2.5% repricing. It's a very massive number when it plays out over one full year of rate hike. So I think somewhere consumer power goes down, corporates profitability goes down when rates are hiked. So hypothesis really is that RBI, when it does the monetary policy, either tightening or easing, it clearly gives us big support to Indian economy, Indian consumers, Indian corporates. Fed, on the other hand, has a different role. Fed, actually being the biggest money provider in the world, actually ends up creating more towards a liquidity and sentiment for asset valuations. So as long as RBI policies are concerned, it supports economy. I guess Fed matters to valuations globally and by default to India. That's the way we'll differentiate. Your base question, what can Fed do? Honestly, very difficult to guess. Perhaps not worth it, because we've really gone through a cycle where 1 year back none of us would have even imagined that Fed rate can be as high as what they are today. So let them look at, maybe what they believe is the right indicator for US economy. But my sense is, if RBI has gone for a pause, it's reasonable to believe that on the whole, based on what has happened in US banking system last month, it's fair to presume that we are more towards the end of the rate hike and monetary policy tightening, but not worth guessing the May event.
About your portfolio construction, how have you been using this the phase the last 3-4 months in the market? What are the areas you've gone overweight on?
If you look from a market cap cycle, I think something which is small cap as a segment is where we use the last 3-4 months period to start deploying money. That's coming more from the side of, let's say, market cap. I think from the cycle of market sectors, I think banking, as I was mentioning earlier, been a big beneficiary. Something which is capital goods kind of sector, where Government of India keeps on, doing its own front of infra as well as PLI. So, capital goods, utilities kind of space where there is earning resiliency playing out. So a lot of this, space, and let's not forget, we are entering a cycle where next 12 months, we're going to have too many elections in the country. We have even the general elections coming up. Historically, rural India benefits far more because a lot of efforts gets directed there. So that's another space of market, which is saying that FMCG as a sector also, we've been adding to portfolios.
So, are you constructive right now if one were to take a 6 to 12 month view, or after the rally you've gone slightly neutral? You were, focusing on the valuations a whole lot. They have kind of moderated from inexpensive zone.
Yeah, so I think clearly the range bound market requires some catalyst to move out of the range. And maybe that catalyst perhaps can be what US Fed tells all of us, as I was mentioning. To come out of a range bound market, you need something which is valuation trigger. Perhaps the trigger is going to be Fed. So that's as far as very very near term, next 1-2 months. But yeah, clearly with a 12-month view from today, one is quite constructive on the markets. And as I was mentioning earlier, the best time to invest really is, when you not made money for last 6-12 months, and the nature of market tells us that you have a compounding effect, and lesser the, immediate past returns, higher the probability of making money in the near future. So yeah, definitely it's.
Right. All right, Krishna, we'll let you go on that one. Thanks so much for joining us on the show today.